funding Asia's transition to a green economy with the FT in partnership with the Japan Securities Dealers Association. My name is Simon Mundy. I'm the Moral Money editor at the FT. So during my 7 years as an FT correspondent in Asia, as well as on more recent visits to the region, I got a great insight into Asia's central role when it comes to the climate challenge. On the one hand, Asia is currently the biggest driver of carbon emissions, with a little more than half the global total. It's also terribly vulnerable to the impacts of climate change, whether that's typhoons in the Philippines, desertification in China, or the impacts of rising sea levels in Bangladesh. And yet, as I was reminded on a visit to India earlier this month, Asia is also the home of a hugely exciting and accelerating shift towards greener and more sustainable energy systems and economic systems as a whole. But for that to really happen at the scale required, serious and effective financing is going to be required. And that is going to be the subject of our discussion today. So we're going to start with some opening remarks from Mr. Manabu Morimoto, who is the vice chairman of the Japan Securities Dealers Association. And we're then going to move on to a panel which will focus on how the transition to a green economy in Asia is to be funded. That will feature Mushtaq Kapasi, who's the Managing Director and Chief Representative for Asia Pacific of the International Capital Market Association, Naoko Nemoto, who's a professor at the Waseda Business School and also governor at the Government Pension Investment Fund of Japan, and Kamran Khan, who's a Managing Director and Head of ESG for Asia Pacific at Deutsche Bank. We will have about 5 or 10 minutes at the end when I will share some questions from the audience, and you can submit those questions at any time from now via the Q&A box that you should see on the right-hand side of the screen. And you're also very welcome to share your thoughts and tweets on social media, and please use the hashtags hashtag digital dialogue and hashtag FT finance. So before we move on to the panel discussion, I'd like to hand over to Mr. Morimoto to give some opening remarks.
Thank you for the kind introduction. It's my great pleasure to welcome you all to this virtual event. As a proud host of today's webinar, alongside Financial Times, I'd like to say a few words. In today's increasingly interconnected world, lots of various uncertainties are spreading out there. In addition to the COVID-19 pandemic, we are facing climate change, digital divide, geopolitical fragmentation, youth disillusionment, population aging, and so on. Considering how such growing uncertainties impact the Asian economies and their future path for sustainability, we have to seek effective strategies and tools for tackling climate change, which is today's focal point. It is often said that Asia may face more severe impacts posed by climate change than other regions. Some research points out the high probability of average temperature increase, more lethal heat waves, storms, and drought. Here, how we can achieve a net zero society without the expense of Asia's steady and sound development will be a question to mull over. But it is my firm belief that development and sustainability are not mutually exclusive. Instead, in many ways, they are synergistic. And a new framework of what we call sustainable development, To enhance resilience against the threat posed by climate change, sustainable development could be a reasonable strategy to underpin concrete progress to problem solving. Under the strategy, in order to steadily move toward our goal in Asia, where the fossil fuel industry is still prevalent, incremental steps for certain regions and industries in the form of transition finance can be a key driving force. However, while each industry and jurisdiction may undertake these initiatives at a different pace, simply a patchwork of efforts will not be enough. To truly achieve a net zero society calls for a concerted effort in Asia. More discussions among all the parties concerned are expected. It is my great hope that this webinar will provide an opportunity for such communication and serve as a valuable space to discover Asia's potential toward carbon neutrality. Thank you for your attention.
Thank you very much, Mr. Morimoto, and we will now move on to the panel stage of the discussion. So I'd like to begin by reflecting on COP26, the climate conference in Glasgow last November, and the impact that had. There was a huge emphasis on finance and funding there. And I wonder, perhaps to start with you, Naoko, what do you think was the impact there, and perhaps more broadly, the shifts that we might have seen over the past 6 months to a year in terms of the momentum around climate finance and financing for the energy transition?
Simon, thank you very much. I think it's quite epoch-making that some Asian country has stated their formal agendas and objective of net carbon zero emissions before or after the COP26. And in Asia, but it's quite critical to smoothly transit to the net carbon zero society. As Mr. Morimoto said, that in Asia, there's many industries which still use a lot of carbons, and also Asia need to develop much faster than some other advanced countries because they need to improve their living standards. So transition is quite important. And I think already many countries are taken initiatives, and I'd like to introduce Japan's government and banks some initiatives in making their study group among Asian countries, and they aim to share some know-hows of the transition finance and new technology. And yeah, I will explain more about later, but that's initiative attended by Asian countries and banks and also European countries. So they are very keen to learn more from their European countries which have advanced technologies.
Yes, absolutely. And your point about the need to expand energy access, I mean, that was something which struck me very powerfully when I was in India earlier this month. And just the different approach to the energy transition. In the UK, for example, the emphasis is on replacing fossil fuel sources of electricity. And because India has such a strong need to expand the total amount of energy that's provided, the focus is not currently on replacing existing sources of energy. It's about adding to it and then later on the focus will move to retirements of coal plants and so on. Just to stick with the sort of fallout from COP26, because there was so much interest in it at the time, and it was hoped that it could be a certain sort of watershed. Cameron, from your point of view, was that an impactful event? You know, the conversation around green finance, climate finance in Asia, has there been a shift since then, would you say?
I think first of all, thank you for the invitation. It's a pleasure to be here. There are two things that really struck out when I was in Glasgow for COP26. First was the interest in what is happening in Asia with respect to ESG. I was quite surprised to see how much global corporations were concerned about how their business is playing out in Asia. What impact are they having? Is it positive, negative? Do they have risks, and so on? So I think that bodes well for the importance of Asia. The second thing, a lot of people commented on how some were dismayed, not enough commitments were made, and so on. But the point that came out of COP26, which didn't get enough attention, was around carbon trading. So this, the world experimented with carbon trading a few years ago. It was not a very good result. This time around, there was unanimous decision from developing and developed economies that we need to now embrace carbon trading. That is a key tool in the fight to deal with the climate challenge. And variety of expert groups and private sector groups were sent off to come up with a more methodological, more scientific, more precise way to measure, set standards, and trade carbon. And I think that is going to have a pretty massive impact on the development of the ESG market going forward.
Thank you. Mushtaq, there was obviously at COP26, there was a big focus from a lot of people on the need for the developed markets to provide more support to developing markets. Obviously, there was a pledge, a very specific pledge that the developed countries would provide $100 billion a year in climate finance annually by 2020. That was missed by something of the order of 20%. So I wonder, from your point of view, how essential is it going to be that those flows of capital from the rich world to developing countries, and what needs to happen to really drive that forward?
Sure, that's a really good question, and I think it's unclear exactly how much of the financing is going to have to come from developed countries to developing countries. The specific sources are, I think, certainly up for debate and up to the markets to decide. But I think the kind of quantum of investment is absolutely enormous. That's necessary, and I think many studies have confirmed this. So the question is how to actually encourage those flows. And going back to the question about COP last year, I can't really say what came out of the conference necessarily, but I think one big trend that I've been seeing, or that I've seen last year, certainly from my spot at ICMA, is the increase in focus at an overall country level on sustainable finance. And what I mean by that is that sustainable finance, I think, when it started, was very much a niche product. I think it grew and grew until it became more mainstream within finance, and to some extent started to be supported by national policies, especially in Asia. But what we're seeing now is that sustainable finance and sustainable finance regulation is really coming from the very top levels of government. It's a function of, it's tied to the overall net zero pledges that are coming out of COP and that are coming out of international commitments. So we're seeing that very concretely in Asia, with really a blossoming, I would have to say, or proliferation, however you want to put it, of different proposed regulations, different proposed standards that might be informal in nature on different aspects of the market for sustainable finance, not just in terms of product standards, what ICMA is more focused on in terms of green bonds and so forth, but also things like disclosure standards, accounting standards, taxonomies, of course, are coming in Asia, carbon markets, as Cameron mentioned, and really not to overuse the word, but an entire ecosystem of potential official sector oversight. This is very new, and I think it's a good thing for Asia in general, but I do think there's some caution that we don't want to get too fragmented. We don't want to have a number of regulations that aren't compatible with each other and that go against a little bit the international flows that you mentioned that are so important. I can get into that a little bit later.
Yeah, we're certainly going to talk more about regulation, disclosures, harmonization of standards. So thank you for flagging those really important points. Marco, coming back to you, we touched on this idea of how far the rich economies can really play a really important role in driving green investments in developing economies. So for Japan, as the largest rich economy in Asia, do you think the country is really, and institutions in the country, be it private or public sector, are really starting to capitalize on those opportunities to invest in green investments in other countries? Is it still currently more focused, would you say, on domestic? And how much potential is there for Japan to really play a galvanizing role in driving these investments across the region?
Okay, thank you, Simon, for focusing on this quite important things. First, I mean, not only Japan, but I think also I'm just very interested in some capital inflows from other advanced countries to Asian countries. And my research is ESG investment. And I some research on how our stock prices are performed under the COVID-19. I mean, does ESG factors make any differentiations? And I found that companies with good ESG scores, their price is less volatile. I mean, it's more stable, and that means that those companies attract more stable or long-term investors' interest. And so this is quite important because now Asian market is facing a lot of problems, uneasiness and higher interest rates. So many people are really concerned about their money shift. But if countries or companies are very improving their ESG factors, that could be a very good some factor to ensure resilience. And as for Japan, I'm also working as a government pension investment funds that has a $1.6 trillion assets. And the pension funds are one of the objectives is to increase alternative investment, including infrastructures or private equity funds. And we are quite keen to explore more investment in Asian market. And also when we expand the investment in Asia, ESG factor is quite important. Yeah, I think I introduced the GPIF, but it's probably conceived by many other investors in Japan. So more clear ESG strategy and then disclosure would be important. I mean, for Asian corporate to attract some more finance.
Thanks so much, Naoko. So when it comes to international coordination, cooperation, international flows of capital, one of the things that's on a lot of people's minds at the moment is the increasingly tense geopolitical situation, the war in Ukraine, of course, but not just that. Even before that, we've seen rising tensions for some time now between the US and China. And so all of this has the potential to weigh on a coordinated global response to the climate crisis and a coordinated global investment in the green economy. Kamran, what's your take on this? How concerned do you think we should be about geopolitics really getting in the way of sustainable investment at the scale that we need? But yeah, perhaps Naoko,
go ahead, Naoko. Please go ahead.
Start off, yeah.
Okay, thank you. I don't think that will be a big impediment for the ESG's coordinations, because no one can deny that there's some importance of climate change in the long term, mid to long terms, and also the rise of some energy prices that will give more incentive to the Asian countries to think about more seriously of energy policies and develop new energies. I mean, there are some solar powers and others, or think about more some safe nuclear powers policies. So I think that will probably give more incentive to the policymakers or investors to think to enhance their ESG factors.
Yeah, it's a really important point. Cameron, do you agree on that, or are there other points that you think are really important to mention here?
Yeah, so I think before I jump in, if you don't mind, I'd like to make a quick comment about the capital flows, because I think it's important to keep that topic straight. People get confused when you talk about capital flows. A lot of people think about official development assistance, right? So ODA flows, or they think about G2G investments. And what we're really talking about in the ESG world is private capital flows that are driven by private companies' incentives. So what we're seeing is that our global clients, MNCs, are actually investing in Asia in the south part, so to speak. North-south investment is happening because they want to, this is where the investments are taking place globally in this part of the world. And these companies are making sure that all the new manufacturing facilities they've put in place, all the different distribution networks they put in place, all the sourcing mechanisms they put in place are sustainable. And so that's what's driving the capital flows rather than G2G conversations and coordination. To be honest, this is the best chance the world has that this will happen organically through the businesses as they transform. Now, to your other question about the geopolitical, look, this is one geopolitical shock. There will be many others to come. So for us as people who look at ESG very carefully, the question is not whether ESG as a movement can save the global macro financial situation. The question really is whether ESG instruments are going to fare better or as well as other standard. Thus far, things could change, but thus far, the ESG instruments have performed quite well. And I can tell you that the deal flow that we're seeing has not subsided from the beginning of 2021 to now. And the interest of clients and the commitments to invest in sustainable assets in Asia has not subsided. I'll give you one example in terms of the marketplace. We were just part of Government of Philippines' sovereign bond offering that closed on Monday. And Philippines issued 3 types of bonds in that offering: a 5-year note, a 10.5-year note, and a 25-year note. As you can imagine, 25-year money was the most critical and important for the government, and it was where the pricing was most sensitive. It is telling that they tagged the ESG portion to the 25-year note. So that's their inaugural ESG bond. And they did that because there was more demand for ESG note than there was for standard, net. And it priced very well. So if that's any indication, I think ESG instruments thus far are faring much better than people might have expected, and certainly better than traditional. I should note that it was the first Southeast Asian sovereign to enter the market this year. And therefore, there's a lot of looking around, okay, how would they price and how would the ESG note price? And it priced very well. So I think indications look towards the upside.
Thanks so much. And it'll be interesting to see what further such issuances follow, both from the Philippines and other countries in the region. Mushtaq, so we spoke a bit on our private call earlier about this geopolitical angle. What's your take? How far do you think this could slow things down? The Ukraine situation in the immediate term, but also more broadly. I mean, the US-China tensions, I think the consensus is that will be something that will be around for the whole 21st century. How far do you have concerns about geopolitical issues getting in the way of these flows of capital, this investment that's needed?
Sure. Well, I certainly think they're relevant. The recent events, but also the longer term, issues that you've mentioned. And I think Kamran raises a very good point: is that you'll always have conflict. You always have geopolitical tensions. I mean, I hope less than before. I hope that can keep improving, but I think that's a fact of life. And these things can indirectly affect the sustainable finance markets. They can, of course, very much affect national and global energy policies. But just to take perhaps a narrower view, to echo Kamran a little bit, certainly from our perspective at ICMA, we're not involved in a lot of the specific deals, but in terms of issuance volume, in terms of price performance for sustainable bonds, sustainable instruments, general ESG assets, it's been very strong in 2022 and has continued to do so. And I think the reason for that is because these are still generally private markets. This is capital looking for a good place to be. These are corporates, sovereigns looking for investment, and the market is basically working as it should. Now, one thing to facilitate that are the standards that are put in place, the strategies at a corporate, at a national level, to facilitate climate transition. And so far, at least as far as I can tell, those things are still very much robust. So if you look at it at maybe a more micro level, for example, look at a company that has a transition strategy in, say, energy or in manufacturing, right? Will the recent geopolitical situation affect supply chains and their ability to meet their targets, for example? Will it affect the price of energy or the cost of transition to a more decarbonized mode of operating? Quite possibly. So when you talk about individual instruments, when you talk about the execution of strategy, absolutely, the global situation is relevant. But there's been no talk, and I think there's no intention for anyone I've seen in the market, correct me if I'm wrong, Kaman, to change the standards of what is ambitious transition, what is a good strategy, what is a reliable net zero target. The science hasn't changed at all, right? The levels of ambition haven't changed at all, and the demands from investors to have kind of credible transition policies, to have transparency, to have sort of science-based analysis, those haven't changed either.
That's encouraging to hear. So perhaps sufficient momentum is already locked in that even a terrible event such as what's happening in Ukraine can't derail it.
I'm not trying to go that far, but that's an optimistic way of looking at it.
I mean, but I think you're saying, things are still moving forward. It hasn't been completely knocked off track. Yeah,
absolutely. At the moment, certainly, the sustainable finance market has incredible momentum, and I think you can debate very reasonably whether sustainable finance and the capital markets are sufficient, or to what extent they are going to contribute to transition to net zero, and a 1.5 scenario, for example. I think those are open points for debate. But I think if you look just at the sustainable finance markets in themselves, the growth has been incredible in the last couple of years. And I think more significantly, you've seen sustainability basically become a mainstream part of the capital markets. So it's basically turned from a very niche product that people had, quite frankly, a lot of skepticism about, to something that is front and central to every corporate issuer strategy, and something that any investor, certainly any prominent investor globally, will ask about upfront.
Thank you so much. Yeah. So Naoko, coming back to you, one of the things that is on a lot of people's minds is blended finance, the opportunities for public institutions and private sector institutions to partner on some of these really important areas of investment. Now, blended finance is not a new thing. It seems to be an increasingly fashionable concept, but it's been around for a long time, and it's still, much happening at a much smaller scale than some people would like. So, do you think, both from a Japanese perspective, from an Asian perspective as a whole, there is a lot more opportunity for these sort of public-private partnerships, and how can that really be galvanized?
Okay, sorry, what's what you mean? I mean, in the partnership, it is a partnership for the finance or?
Yeah, so I'm thinking really, yeah. So partnering on finance in particular. So blended finance as a whole, opportunities for the public sector entities to really galvanize that private sector investment. But whether it be through taking first loss or whatever it might be, how much opportunity? I mean, look at the flows of capital that are needed. How far do you think public institutions can really drive those flows by pulling in private sector investment? How much scope is there for that to really grow and take off?
Okay. Let me explain about some transition bonds, for instance, are. Yeah, and in Japan, we issued the first transition bonds last year. It was issued by shipping companies, and the government took a very important role in giving the certificates to the process. I mean, that they apply the ICMA's guidelines, and so a roadmap, and also their assessment is quite important. And also their banks took a very important role in supporting the companies to make the plans and get a lot of feedbacks from investors, because they very keen that it will be regarded as a very reliable finance, and not, they'd like to avoid the greenwashing or lock in the fossil energies. And so that is one thing, I mean, that will produce by collaboration of the public sectors and banks. And also another issue is the initial cost is not so cheap. I mean, or monitoring cost is maybe costly for private sectors. So in some cases, the Japanese government supports some cost of certifications at the initial stage to develop the transition markets.
Yeah, it's an important point when it comes to certifications, standards. Governments and regulators can play a really important role when it comes to galvanizing private investment. Of course, it's not just about using public money, but also putting in place some of the structures that will give private investors confidence to invest. So how encouraged are you, Nako, by the speed of regulatory development in this space, whether it's putting down standards for disclosure or whatever it might be? Do you think the governments, perhaps if we look at the government in Japan, but also other governments in Asia, are governments moving appropriately fast on regulatory change?
I do not think it's very fast, and also compared to Europe, I mean, what is lacking in Asia is there's not uniform or some or more standard initiatives. I mean, among the countries. On the other hand, I think some good thing is, for instance, in Asia, the ASEANs, they are trying to make a taxonomy by themselves. And also another thing is that each country is developing its own guidelines or standards. But as other speakers said, that some problem is that there's not uniformities or so for investors, it's a little bit confusing to see the very various standards and guidelines. So there's a lot of room to improve. And my personal view is it's so difficult to have very single standards. I mean, at this point, but they should be more coordinations among countries, or more clear explanation of the guidelines, and for practitioners, there should be some more clear guidelines, and as I said, that one of the initiative by Japanese government and banks, they are trying to make such guidelines, and also find the difference of each country and make some proposal to the government. I mean, how to make efforts to the conversion of the standards.
Yeah, it's a really important point that you made, Nanako, about the different standards, the sort of fragmentation of standards. Cameron, from your position at Deutsche Bank, how far do you see this as a serious problem? The fact that you have very different standards in different places. They're all still emerging. It's not even the direction of travel is not totally clear. How far is that really getting in the way, in your opinion?
So I have a somewhat controversial view on this. If we had universal standards today for ESG, I would probably be the first one to stand up and say they need to be changed. So that's my perspective into this. This is very new for the world. This movement has a long way to go before it flattens. So it is understandable that there are different things being experimented based on what people think to be important for their jurisdictions. What I can tell you is that Asia is a very competitive region. So here, even regulators have to think about more than just public interest. They have to think about the competitive strategy of that country. If you set up very hard ESG rules, companies will walk across the border to your neighbor. If you set very low and soft ESG rules, people will say you're not very serious about it. So it's a careful consideration that regulators and government policymakers have to walk. The other fact is also not lost, which is it is very unlikely that every small economy around the world, including in Asia, is going to have its own elaborate ESG taxonomy. Even the EU is just now starting to look at social. It was all about the environment. And we know how many years it took for EU to evolve its strategy. So what is more likely to happen is that governments will take baby steps, starting with off-the-shelf programs like TCFD and what have you, and say, okay, this seems reasonable. Let's socialize it. Let's check with our constituents whether they can comply with this. And let's start the process with something that is universally accepted, rather than start from scratch to build a new taxonomy, which will inherently become a very political process where people are saying, no, this rule works in Europe, it doesn't work here, and so on. So that's what we are observing and we expect to take place. We as a bank, of course, a European bank, we are very closely tied to the EU taxonomy. So we are engaged with almost all the economies around the region to share with them what investors are looking for, what other standards look like, and what might be useful next steps for them.
Thank you so much. I'll remind the audience, we've had a lot of good questions coming in already. Please do keep them coming, and I'm going to try and address as many of them as possible. But first, just coming to you, Mushtaq, on this question of standards. So, I think Cameron was suggesting that, we're still at the sort of sandbox experimentation stage. At this point, that's healthy. We want people to be competing and experimenting. Do you agree, or do you think already we can say, as some do, that, it's a problem that everything seems so fragmented?
I would take a view somewhat in between there. So I think there's a lot of talk about fragmentation, about the different standards, about the need for harmonization, or at least further harmonization. And certainly that's the point of view that most of ICMA's members and those who are stakeholders would mention, because they're involved more internationally and they have to deal with multiple jurisdictions, multiple standards at a national level, and more harmonization would generally be helpful. So as a very general matter, that's ICMA's position. But just for this panel, let me take a little bit more of an optimistic point of view and make some observations. So first of all, if fragmentation or the different standards was such a huge problem, we would presumably see that effect on the markets, and we're not, right? I mean, last year, for example, we just did a bit of research at ICMA showing that 16%, 1/6 of international bonds issued out of Asia were sustainable in nature. So green, social, sustainable, sustainability linked. Okay, that's a huge increase from a couple of years back when green social bonds were just a drop in the bucket. And we're also seeing in Asia that percentage is higher than in other regions, right? So we're seeing that the sustainable instruments are still being successfully issued in Asia, and as Kamran said with his example on the Philippines. So the market hasn't shut down by any means if this is such a big problem. Also, in terms of all the different kind of competing standards, let's take a step back and realize that still 98% of sustainable issuance last year was consistent with the green bond principles, social bond principles, sustainability linked principles, or sustainable guidelines. So basically the principles that are organized by ICMA. So while there are certainly different standards at a national level, there are different ways of evaluating these instruments. Overall, when you talk about sustainable finance issuance in the debt capital markets, it's all pretty much following the same guidelines. And there's not much disagreement around the world in any region what those guidelines should be. Also, I want to strike a bit of an optimistic note about cooperation between countries. We think that it's more fragmented, that no one's agreeing, that there are all these differences. But I want to highlight, for example, what's happening in ASEAN, where the 10 countries of ASEAN are very, very different, and yet they not only achieved the ASEAN Green Bond Principles or standards and social bond standards back in 2017, when this industry was really in its infancy, but they're also working together on the taxonomy, and they've actually come up with something that the entire region can agree on, and that will actually drive a certain level of harmonization within the region in terms of the national taxonomies that come out of it. Also, another thing that I think is a big achievement is the common ground taxonomy from EU and China. Now, again, this is not a new taxonomy. It's not intended to be kind of a universally applied taxonomy, but it's a very helpful mapping between the EU and China approaches, and I think shows that while there are differences on the margins, the vast majority of the taxonomies are actually kind of consistent in terms of their content. And last but not least, I actually want to highlight ICMA's how do I put it? ICMA's happiness about the Japanese initiative for transition finance. And I think one unique thing about this, not only is it a government supported, it represents government support of sustainable finance, which I think is actually very helpful to the domestic markets in Asia to have that official sector seal of approval. But I think what is unique about Japan's approach is that it represents real cooperation between different ministries in the government. So elsewhere in Asia and sometimes in Europe as well, you see the securities regulator doing one thing, you see the Ministry of Finance doing one thing, you see the Ministry of Environment doing another thing. Well, in Japan, you've really had the cooperation within the government, which I think is hugely powerful and a model for other countries.
Thanks so much, Mushtaq. So we've just got time for a few audience questions, and there's one that's for you, Naoko, which is what is GPIF doing, or what will it do in the future to help with the development of ESG standards in Japan, as well as helping that sort of interaction with other markets, perhaps even the development of standards in other markets? So what's going to be the GPIF role there?
Thank you for questions. I'd like to point out 3 things. One is increased awareness in Japan. The GPIF assigned the PRI in 2015, when there not many investors were knowing about the ESG, what ESG means. But so as the largest pension funds greatly committed that very market participants and private sectors were aware of the importance. And second is ESG indices investment. It's very increasing every year, and so indices focus on some, for instance, energy and low carbon emissions factors. And private sector corporate have a lot of incentive to be included in indices because it has very influential funds. So I think incentive is very important. And third is the incentive for asset management companies. They choose the asset management companies based on their integration of ESGs or their know-hows and the depth of the analysis. So for asset management company, it is quite critical to be selected by the GPIF. So that's the three things. But some challenge is to how to monitor the performance of the factors, ESG factors, or in the long term. I mean, still we have short track records, but the ESG's performance should be realized in the long term. So how to assess is quite important.
Thank you very much, Naoko. Cameron, a question for you from the audience, which is a very interesting, sort of almost philosophical one, but certainly a practical one also. Eventually, do you think that ESG sort of disappears as an asset class because all investment becomes ESG linked? No investment would happen without ESG considerations. And then at some point in the future, ESG is just so thoroughly incorporated into every investment strategy that we no longer have this separate strategy called ESG. What do you think?
I think that's really what we all hope, right? That's the hope for the world. I would say that a couple of things. One, we as a bank absolutely are moving from our commercial strategy as well as our branding and profitability strategy. We're assuming that ESG will permeate every aspect of the financial services industry. So that's not a surprise for us to have that kind of assumption. We are absolutely looking at ESG showing up everywhere. You now have ESG contingent M&A transactions. You have ESG linked derivatives, which we have been leading on. So we have ESG ETFs. It is going to be everywhere. The second thing I would say is, it's been asked of me, when would you know that we have arrived in the ESG market? Somebody asked me that, and my answer was, the day when I can see that in the secondary market, a well-performing ESG instrument is driving premium over other instruments, which means that the investors have the right disclosures, have access to the information, and are educated enough about ESG issues to make investment decisions based on not just returns, but also non-financial impact of those investments. And I would conclude by saying, this whole idea of standards, we forget the responsibility of an investor. You can look at, disclosure and reporting requirements. That is a government regulatory standard issue. But imagine when you make a normal investment without ESG, you don't look at standards. You look to see whether this is a good investment for you or not. You do the analysis on the financial profile of the case, and you make a decision on that. Why should ESG be different? So if you're an investor, you need to have your own standards of what is acceptable to you from a non-financial impact standpoint. Yes, it'll be nice to have some standards around that you can borrow from and know that you'd be in compliance when you have to write a report to the regulator. But the fundamental investment decision sits with the investor, and all investors have a responsibility as money managers to know what kind of investment standards are they setting up with respect to non-financial impact.
Thanks so much, Kamran. There are so many more questions that I could ask, both in terms of the questions we've had coming in from the audience, as well as questions that I have myself. Unfortunately, we are out of time. Thank you so much for a wonderful discussion to all our panelists, Naoko Nomoto, Mushtaq Kapasi, and Kamran Khan, as well as, of course, to our sponsor, the Japan Securities Dealers Association, and to everyone in the audience for tuning in. This session will be available on demand for 30 days on the event website. So please do feel free to catch up on the most important bits, and do share it also with friends and colleagues if you found it useful. And we'll hope to see you again soon for another FT Live event. Thank you very much.
Thank you, Simon.
Thank you.